How important is inflation to a long-term investor?
Inflation is critical. Inflation is, to some degree, the enemy of the long-term investor. In its simplest form, inflation is the rising cost of the products and goods that we buy over time. For example, if today I needed $100,000 per year to live if I were retired, with reasonable assumed inflation rates, 30 years from now my cost of living would likely triple. I'd probably need something close to $300,000 a year to be the equivalent of $100,000 today. So when we think about building investment strategies and saving for our futures, it's very important that we're saving enough and/or a combination of our savings plus investment returns can outpace this rate of inflation. Inflation is a difficult thing to deal with from an investment point of view as well. We need to think about investments that are likely to be able to outpace inflation. Over the long run, the kinds of investments that have been able to earn returns in excess of inflation are assets that do have some price volatility along the way. Things such as stocks, real estate, commodities, gold. These are examples of assets that have been able to keep up with or outpace inflation. What we know does not keep up with inflation are bonds. Bonds to some degree could be thought of as inflation. The market's best indication of 1 year's worth of inflation is a 1-year bond. So the most you're likely to get out of a bond with a 1-year maturity is the inflation rate. Now, if investors were to consider going out longer term, buying bonds with 5, 10, 15, 20 years to maturity, they may be able to earn returns that are modestly greater than inflation, but still the differential would not be great enough to have them keep up, especially when we factor in income taxes, which also erodes investor returns after taxes before we hit inflation.